On January 20th, 2026, I uploaded a YouTube short saying Netflix had dropped to a monthly low around $83 and was likely to rebound. The very next day, NFLX opened near that price and went up $4 on Wednesday, had a small pullback on Thursday, and then rebounded another $3 on Friday. That's not luck. That's using two-layer high-low trend lines to project probable highs and lows before they happen. Now let me show you how the exact same logic applies to NVDA and TSLA for the next period. This method is called two-layer high-low prediction. It's very simple. Layer 1 tells you the nearest reaction zone. Layer 2 tells you the most likely high and low range. No indicators, no lagging signals, just forward projected probability zones. Layer 1, trigger range, refers to the tips of the nearest trend lines to current price, at prices with specific matching colors at the y-axis, which represent the first reaction zones where price is most likely to pause, bounce, or break. High 1 and low 1 are the closest trend lines to current price. These represent where price is most likely to pause or react first in the next move. Think of layer 1 as the first wall price is likely to hit. Layer 2, structural range, refers to the tips of the thick yellow trend line on top and the blue trend line below the green one, at prices with specific matching colors at the y-axis, which represent the most likely high and low range for the next time frame under review. High 2 and low 2 are the main forecast range. These are the thick yellow trend line on top and the blue trend line below the green one. This is the statistically reasonable high and low for the next time frame. And your key rule, this is very strong. If this is a daily chart, those tips project the next trading day. If this is a weekly chart, those tips project the next week. Now let's look at NVDA on the weekly chart. The inner lines, high 1 and low 1, show the nearest reaction zone. These are where price is most likely to stall or bounce first. But the real forecast comes from layer 2. The tip of the thick yellow trend line gives us the projected weekly high. The tip of the blue trend line below the green gives us the projected weekly low. Together, this forms the structural range for next week. This doesn't predict exact price. It defines the probability envelope where price is most likely to oscillate. Now let's apply the same logic to Tesla on the daily chart. First, identify layer 1, the nearest high 1 and low 1 trend lines. These are the first reaction zones. Then identify layer 2. The thick yellow line is the projected high for the next trading day. The blue line below the green is the projected low. That zone between them is the most likely daily range for TSLA. Higher numbers mean farther distance and higher risk. High 1 is low risk, high 2 is stretched, high 3 is tail risk. Markets rarely move randomly. They move inside projected high-low probability zones. The closer price gets to the inner layer, the more likely a reaction happens. We're not guessing direction. We're defining where reactions are statistically likely to occur. If you want to consistently forecast next day or next week ranges without indicators or lag, start using two-layer high-low trend lines. It's the same method I used on NFLX, and the same method I'm using on NVDA and TSLA right now. Follow, subscribe, and I'll keep publishing real forecasts before they happen.